Hello and welcome to today's premium account market update for September 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals. I have 18 years of experience in the financial services industry, current licensed securities and derivatives advisor. The format for today, we look at the macro update driving equities as we roll through the ASX top 50 stocks with a particular focus on the FES 17 earnings outlooks, the technical trends, our portfolio allocations, and a short-term market outlook. The premium account service offered by Investor Signals is based around a model portfolio of ASX top 50 stocks. If you'd like to know more about the service, please contact me using the Sydney 02 number on screen or Leon at investorsignals.com. Moving straight into a graph today of the Dow Jones. Now, the US markets have consolidated just above the breakout resistance level that we'd been forecasting. So the market had been bumping up against around this 18,000 level. It broke above it, and now we've seen a retracement back to it, and last night we've seen a slight sell-off in the bond yields and a recovery in the equity markets. Let's roll through sort of all the major indices or macro picture and see if we can sort of bring this together as to what's been going on in global markets. This is a graph of the 10-year treasuries in the US. We've seen the yields rally from 1.3 up to about 1.7. And that's really on the premise that the market started to price in that the Federal Reserve's ultimately going to begin an interest raising cycle, and there's obviously been a lot of speculation about whether that 25 basis point increase occurs in September or does it occur in December. But ultimately the big macro picture that's changed is the market's gone from being concerned about deflation and the prospect of the US following a similar path to Japan, where ultimately leading to negative rates, to actually having a view that the US economy is strong enough for rates to start to rise, and that's been reflected in these bond yields that have pushed higher, and I'll get to the relevance of that as we move through the top 50 stocks in a moment. In addition to the 10 years, this is the 30 years up on screen. We've seen the 30-year treasuries in the US push from a yield of 2.1 up to around 2.5, and the sharp moves really occurred in the last 5 days or so, and that's coincided with equity markets pulling back, and in particular we've seen the ASX actually pull back roughly about 7% from its highs. So up on screen there's a graph of the XJO. So the pullback here from around 5,600 odd points back down to 5,200 points, and we're just starting to see a little higher low formation. Now, I'd spoken in the past about since May last year we'd seen the market in a structural downtrend of lower lows, lower highs. The first real bullish signal we had was at late June. I think roughly around the 28th of June, we had a higher low structure. The market rallied up, created another new high, and now what we've got is volume building and a higher low formation coming in, which I would have to say from a technical perspective is a fairly bullish signal. So we give this rally the benefit of the doubt, and we start to look for buying opportunities in equities on a select basis. To conclude sort of this global macro, let's just roll through a couple of the other sort of big markets around the world and see what trends we're seeing. So the Nikkei, I've always maintained out of all the sort of global major indices, the Nikkei to me appears to be the weakest, and we're yet to see it break into a high structure. So you can see there I've illustrated on screen until it trades through roughly 17,900 points. I don't get bullish on the Nikkei. I think the pressure's still to the downside. Interesting, out of all the markets, you're seeing central bank there in Japan being an aggressive buyer of exchange traded funds. So they're now holding roughly 10% of sort of top tier equities in Japan as through their exchange traded fund buying, which is part of the stimulus program. Shanghai Composite in China, I'd spoken some months back about how I was expecting this to break sort of through this 800, 2,900 level, go on to make higher highs. I think this index at the margin is gradually starting to look a little bit better. There's still some structural issues and a significant amount of debt in state-owned corporations in China, which worries the market. But to me, I think this picture's starting to look a little bit better there, and we've actually seen that reflected in the last, say, 3 weeks or 2 weeks in particular, where we've seen better economic data come out of Japan. We're both at the, I think, at the services level and at the manufacturing level, which has been pleasing. The Hong Kong market, this has proved, so the Hang Seng, this has proved to be probably one of the stronger breakout markets, and we've seen this rally through, create a higher high. I think that sets up a pattern that any pullback that we see here is a buy on the dip. NASDAQ and S&P 500, just to chat on those quickly. You may recall some months back in the monthly strategy piece I was watching on the NASDAQ that we had this sort of slightly lower high structure, but ultimately the forecast was that the market would actually break through that, and we've seen this rally occur and break out to the upside. I think, again, that's bullish. I think you look for support on the NASDAQ back at around 5,000 points, but ultimately it consolidates and moves sideways and maybe forms a base around here, which should be positive for equity markets. S&P 500, not too dissimilar to the Dow, where we've seen it sort of break out, find support last night. So early days yet, but my thesis really is that the equity markets are relatively expensive. The adjustment in bond yields is starting to play out. So I still think that investors are doing themselves a disfavour if they're not running a covered call strategy or a derivative overlay over their Australian equity portfolio to enhance the returns, as I don't think the actual upside in equity markets is significant from here. And just to have a quick look at a couple of others, gold, interesting here, higher highs, higher lows. If the US dollar starts to move higher and rates move higher, you would think that gold starts to struggle a little, but let's have a look at that when we get to Newcrest, when we move through the top 50. A quick look at a couple of currencies. The Aussie dollar versus the US dollar, range bound here, trading at around this 75 level. We'll continue to visit that over the coming months to see which way it breaks out of that range. And the euro, the same, consolidating here at around 112. We'll keep an eye on which way it breaks out of that range. Okay, moving straight into the first of the ASX top 50s, and I'll move through these quite quickly. We've concluded FY 16 earnings, and the focus now really is what does the earnings outlook into FY 17 and the yield story look like. I think AGL delivers about 7% underlying earnings growth. The stock's back on about a 4.5% dividend yield. I'd always maintain that it was getting expensive up here. I think this sell-off's probably been a little bit deeper than even I anticipated, but I think down here it's good value and worth having some exposure to at or near this price point. Amcor delivered an earnings result that was in line with expectations. I've got the stock trading on a forward yield of around close to 4% at the moment, 18 times earnings. The company should deliver 7% earnings growth. I think it's a buy again on this pullback. Don't expect it to do too much more over the next 6 months. Maybe could trade up to $16. We own it in portfolios, complementing it with covered calls, delivering 10% cash flow from the dividend and the call option, plus allowing for some capital gain there. AMP, look, this has never been one of my favourites, but the more research I read on this, I think unanimously investment bankers are starting to, and research houses are starting to have a much more positive view on AMP. Looking at it from a technical perspective, it's been in a downtrend of lower lows at the margin. It probably just slightly created a higher high, and here we are at the moment, maybe at the early stages of a higher low formation. So I'll give this the benefit of the doubt and say it certainly deserves to be on the watch list here at around 5.30. The stock trades on almost a 6% dividend yield at the moment. So even in an environment where earnings remain flat, which is what has happened over the last 12 months, maybe it could trade up to 5.50 just on some further yield compression. ANZ, look, the market actually liked some of the restructuring story here around the repositioning of ANZ and dealing with some of the issues from their global banking, or in particular their Asian expansion strategy. I have ANZ back on over a 6% dividend yield, but when you look across the earnings results of the bank, CBA delivered about 3% earnings growth, and I think roughly on the numbers, the others delivered somewhere between flat to negative 3%. So there's not a lot of excitement here in the banks from an earnings growth outlook. I don't think there's a lot of mortgage growth that's driving earnings. And therefore, maybe it just remains a yield story, that if the market can be comfortable that the Australian housing cycle is going to remain robust, our employment level remains, unemployment remains okay, maybe the banks can just consolidate, move sideways, and in a bullish market we could see a little bit more of a squeeze to the upside, but it's hard to build a case for a whole lot of earnings growth over the next 6 months in these banking names. But interesting, ANZ's one of the few banks out of the major four that actually have a higher high, higher low structure. So I just flagged that out of interest. Not doing anything there at the moment. ASX, now this stock I've obviously liked for a long time. The yields compressed down to 4%, underlying earnings growth at around 5%. Some of the recent data for July, August, as far as transaction volume goes on the ASX, the numbers are actually starting to peel back a little, which could have an impact on earnings in FY 17. So at a 4% dividend yield, maybe even questioning whether they can deliver 5% earnings growth. I think the stock's getting expensive from a technical standpoint. The picture still looks bullish in that we've got a new high-low structure here. But again, I think maybe the argument is it really just moves sideways. AZJ was one of our stocks on the short side over the last few months. The stock really collapsed as expected. Our concern there was a company had no revenue growth, paying out 100% of their earnings in dividends, no margin for error. The haulage numbers have not been particularly good, and we've seen the stock correct, probably something in the order of 15%. I think down at these levels, to put some numbers on it, AZJ now trades about 16 times earnings on a 6% dividend yield, which looks attractive, but the risk still exists there in January that the company actually reduces its dividend payout ratio, and therefore obviously reducing the dividend in the process. So we keep an eye on AZJ, but still some concerns there around the impact to the pricing post the adjustment in yield. BHP, look, from everything I read, we're seeing record production out of steel production out of China, which is quite a surprise. On the same time last year, I think exports were up at about 3% on the same time last year, so volume still remains strong for iron ore. Obviously, iron ore prices remain depressed, and as do oil prices, which is not boding well for BHP. But nevertheless, I think it can trade up to our target of around 22.50. We have been active in selling covered calls up at that level to help complement the relatively low dividend stream that's coming out of BHP. So the recent dividend that BHP paid was only around 33 cents. We may see that tick up a little bit higher over the next 6 months. Brambles, I think this is a buy on the dip down here. So the stock's still expensive, 20 times 2017 earnings on a 3% dividend yield. So I don't think we're looking for it to rally back and create a new high, but I think it can trade at $12.50. So to me, it's a buy here. Let it rally back up to around $12, sell the $12.50 calls. Collect the upcoming February dividend. I think sort of as a story there, we're getting 10% cash flow from the dividend and the call option, plus allowing for maybe up to 10% capital gain over the next 12 months as well. So I like Brambles at these levels. CBA, a little bit overdone. Again, look at the technical structure here, lower lows, lower highs, different story there to ANZ. I have CBA back on almost a 6% dividend yield, so I think it can just trade a little bit higher. not looking for much in the way of earnings growth. Coca-Cola pleased the market. We're seeing the continuation of moderate single-digit earnings growth coming through here for Coca-Cola. Got the stock on 17 times earnings, now on just under a 5% dividend yield. Pretty hard to say that it can trade too much higher than where it is. I think it consolidates and moves sideways, and we continue sort of happy there as a buy-right strategy on Coca-Cola. Computershare had been missed earnings estimates for the last probably 12, 18 months. We've seen the structural lower low, lower high pattern. The latest result, stripping out the higher tax rate that the company had, the actual underlying business seemed to have stabilized, and that's where we're seeing this pop in the share price and the market sort of holding this level. I still don't think there's enough evidence to say that it's moving into an uptrend. Any pushback up around 10.50, I'd take the opportunity to sell covered calls and continue to drive cash flow from the dividend and the call option there. But maybe Computershare's no longer on the short list in the market. CSL, I think this is a buy on the dip back here at $100. The stock's still expensive, 27 times earnings on about a 1.75% dividend yield. We own it from back here at lower levels. We sold 110 calls into December. We got great premium for those, so we're earning over 10% cash flow out of CSL. I think the stock sort of is back at a support level, but maybe trades up to a maximum of 110, which should sort of fit perfectly into that covered call strategy that we've set up there. Keltex, this is one of our preferred names. It's consolidating and really hasn't done too much to the upside, but up 15 times earnings and a 3.5% dividend yield. The company can grow earnings over the next sort of 1 to 2 years at around 7% per annum. I think that sort of supports the stock maybe pushing eventually back up to $35 to $37 as our target. But we own it here. We've sold covered calls up at those levels. So again, a combination of the dividend and the call option, we're driving almost 10% cash flow. Now, these property trust names have all copped a beating, and that's a direct reflection of where earlier in the presentation where I highlighted the bond yields have moved higher, and that's caused money to flow out of these defensive yield names of the market. And over the past few months, I've spoken a number of times about how the yields compressing down to almost 3% on some of these property names just offered no risk reward for investors, and we're all wary of waiting for this adjustment in price to come through. And to the extent that we've had any property trust exposure from lower levels, we've been selling very tight at the money covered calls, so we actually haven't been impacted in any way by this sell-off, and we're really now back to sort of our fair value. And in the meantime, we've collected again a combination of the dividend, the call option, roughly 10% income, with the prices now back at roughly sort of where we see fair value. So Goodman Group, a good example of that. I'd warned about this one up at compressing down to 3%. Even at the moment, I've got it back at about 3.6%. So out of all the property plays, probably it and Westfield are the more expensive, but I think it finds support here at around this sort of price level of sort of, say, $7 or just under. GPT, we like this within the property trust space. In particular, focus around office trust. The stock's back on a 5% dividend yield. I think at best these names, it's a reversion to the mean, so it's not as if they're going to rally back and take out these highs anytime soon. The only catalyst that would do that is if we saw a sort of tectonic shift in the investors' outlook for US rates. At the moment, investors are pricing in rate rises, albeit very moderate ones in the US. If investors were to reverse view and see that America was probably going to go the same path of Europe or Japan, where deflation and lower interest rates and maybe eventually negative rates was the trend, then in that environment, property trust could probably do better and take out these highs. But I think for the moment, at best, there's probably 5 to 7% bounce in these property trusts. So our strategy is to own these and sell tight covered calls, collect the dividend, collect the call option income. IAG in the property space, probably nothing too exciting there on the earnings result. We saw their insurance margins pull back a little bit at the moment into 17. It's 15 times earnings earnings on a 5.5% dividend yield. I think the stock can trade back up to 550. Not doing there in IPL at the moment. James Hardie, I still think sort of these property names remain a bright spot. US housing construction continues to look good. So whether it's Boral or James Hardie on any pullback, we continue to like these names. James Hardie's in the model portfolio. We own it at lower levels. We've sold covered calls up at around the 22.50 level. So we're capturing the opportunity of some capital gain, but we're also getting very well rewarded in the cash flow from the dividend and the call option income. Lendlease, I'd warned that the market had got too bearish on this coming into the earnings result and to expect it to rally in the earnings result. And we've seen that. I think the underlying earnings growth came in at around 12-13%, but the big point that the market was worried about was settlements on units, in particular in Sydney and Melbourne, expecting to see problems in the earnings results around that area, and the settlement defaults were at record low levels. So there's nothing there that's really going to diminish Lendlease's earnings, it would appear, over the next 12 months. So now that the stock's broken out, created a higher high, maybe a higher low, I think the argument here is the stock can push back up to 14.50. Our strategy here was to let it rally up to 14.50 and sell covered calls. We did that. So while it was on its high, we got very good premium for the call options there. And again, driving good cash flow from the dividend and the call option income. Not doing there in Mirvac. Medibank Private, the sell-off here has been a little bit deeper than expected. I think the earnings result disappointed. In particular, just seeing some loss of clients within their obviously insurance business, and maybe not quite the benefit in the cost out program that we saw over the previous 6 months. So to put the context around valuation, Medibank's now on 16 times earnings on a 4.5% dividend yield. I think sort of 250 up to around 275 is the range for Medibank Private. Macquarie not doing there at the moment. NAB, so again, out of the banking stocks, we still see a bearish structure here of lower lows. NAB's on almost a 7% dividend yield, but not much in the way of forward earnings growth. Newcrest, let's go back to sort of that picture at the beginning of the presentation there of the gold prices. The gold's still in a bullish uptrend of higher highs and higher lows. However, if US rates begin rising or the US dollar starts ticking up, it could be a negative for gold prices, but at the moment we have to say the momentum's heading higher, and really, if anything, it's probably still a buy on the dip at these levels here. The energy names have been under pressure as we've seen oil sort of pull back from its recent highs. So Origin, Santos, Oil Search, Woodside, all under pressure at the moment. Orica, this is one of the stocks we've been on the short side of from around 15.25. The stock made a low of around 13.80. It's having a little bounce at the moment. We keep an eye on this. We were looking for a target down to around 13.75, but we'll have to keep stop losses in place there just in case that breaks out higher. Oil Search at around 6.50 looks okay, but obviously oil prices in general are sitting sort of on their recent lows at the moment. Qantas, this is one of the other short names that we're involved in at the moment. So we shorted around 3.50, targeted around 3.20. It's pretty close to that there. We'll look to shut those shorts out in the near future, in the coming days on Qantas. It's worth also just noting that Qantas obviously have a share buyback going on. And from my numbers, they look to be buying back maybe something around 10-15% of the market volume is actually being conducted by the company share buyback. So quite reasonable, which then makes it interesting just to note how even in the face of that added buying support that the price of Qantas is actually not doing so well. QBE not there at the moment. Ramsay Healthcare, I think obviously the trend continues to move higher here at 30 times earnings. The stock's expensive. Rio, from everything I'm seeing on the export volumes of iron ore, one would think that maybe Rio and the slightly better data out of China one would think that maybe BHP and Rio do find some sort of buying support here. In saying that, when the stock was a little bit higher, we took the opportunity to sell the $51 calls over Rio to bring in some extra income. I think sort of moved sideways, but starting to sort of have a view that possibly there's a little more upside in BHP and Rio. Centre Group, so this is one of the property trusts. We've seen it pull back, and in percentage terms, quite, really almost 20% we've seen this correct from 550 back to 450, which is a big movement. And again, that's all just a result of bond prices in the US and globally but predominantly in the US starting to move a little bit higher. And we've seen money rotate out of these defensive yield names. I think it's overdone down here. The stock's on a 5% dividend yield. I think it trades back up towards that $5 level, and I think it's probably one of the more compelling opportunities that we've been allocating money into on this sell-off at the moment. Seek, I continue to like this name. I think it's a buy on the dip. The underlying earnings growth story remains fairly robust there. Stocklands, now I'm not particularly fond of Stocklands within the property space, but it has pulled back a fair bit. It finds support, but not our preferred buying opportunity. Within these healthcare names, I think Sonic's a buy down here. The company probably one of the standout results of the last month's earnings season. Sonic trades 19 times earnings on almost a 4% dividend yield. I think it consolidates down here, can trade back up to around 22 as a target. So we own it at lower levels. We've already sold covered calls out into December at around the 22.50 level. We got very good premium for those. But for clients that are not holding it, I think it's another opportunity to take a look at it at these levels. Suncorp, so within obviously more insurance than it is banking, about 70% insurance. Is making a higher low, and for that reason it comes onto the radar here at around 12.50. The stock delivers about a 6% dividend yield, so it might be worth just keeping that one on the preferred watch list. Sydney Airports, Transurban, again, all these yield names have pulled back substantially. I have Sydney Airports now back on about a 5% dividend yield, and I think the underlying business still looks good in the sense that we're seeing roughly about 10% growth in the distribution or dividend payment over the next 12 to 24 months. So I think that underpins the price. I think maybe Sydney Airports could trade back up to around $7. But again, I think these names struggle to take out the recent highs. So I think the bounce takes place, but it's a little more moderate than probably what we've seen in the past. So Transurban back here at 10.75, I think this is a buy, back at almost, say, 4.75% dividend yield. But again, the yield will go from 45 cents in the last 12 months up to around 50 cents in distribution over the next 12 months. So I think the story sort of continues to look attractive on Transurban, and this sell-off is a buying opportunity. Telstra down here, it's been surprising how deep this sell-off's gone. Telstra's on a 6.5% dividend yield. I think fair value is back at around 550 there, and it's a buy on the dip down here. Treasury Wines, I think for my analysis, this has probably been the best earnings result. So Treasury Wines has just recently been added into the top 50 stocks. The company can deliver close to 20% earnings growth both in 17 and 18. I think that continues to underpin ongoing upside momentum here in Treasury Wines. And so I think it's a buy on the dip, and it deserves a place in client portfolios. Westpac, lower lows, lower highs on a yield basis. I have Westpac at about 6.5%, but nothing exciting there across the major banking names as far as earnings growth. Wesfarmers, we saw that ratchet back in the overall earnings result, weighed down by a slower growth rate in coals and within their resource sector. So we have Wesfarmers on 18 times earnings on just under a 5% dividend yield. We own this name at lower levels. We'd sold the covered calls. So again, instead of earning 4 or 5% through the covered call strategy, we're earning in excess of 10% cash flow from the dividend, the call option, while still allowing for almost 10% capital growth from the levels that we bought it at there. Interesting, when you look at Wesfarmers, you can almost go back 2 years now and say that the stock's essentially at the same price it was. And I think for clients holding portfolio of Australian equities, I think this is a good reminder of the benefit of using covered calls and where the investor signal strategy can help add returns to your portfolio. Westfield, within the property space, this had started to get expensive. I'd warned about it compressing down to the low end of the 3% dividend range. Even with the correction that we've seen and the moderate uptick in earnings growth, I have the stock on about a 3.7% yield into FES 17, but I think it's a buy down here. I think it can trade back up towards $10. Woolworths, we were right to not sell covered calls over this. We thought the earnings result would allow for a little bit of a correction to the upside. I think there's a bit of a short squeeze there. The market's pulled back to probably fair value. The way I look at Woolworths at the moment is over the next two dividend payments, I think the company can pay out about 40 cents in each payment, which will pay out about 80 cents for the year. And on my analysis, that puts the stock on about a 3.8% dividend yield where it is at the moment. So you would think that the new range is maybe $22.50 up to around $24. Any push back up towards $24, I think it's worth looking to try to sell covered calls to drive extra cash flow out of it. Woodside Petroleum, just pointing out higher high, higher low. We could begin the early stages of a reversal here, which will probably fit in with my thinking that I think the pullback in oil at the moment might create a higher low structure and oil prices actually find support at or near where they are and gradually trend higher over the next 6 months. And there we are back to the index. So to conclude, look, there's buying opportunities in the market. In most cases, I think the uptick's only moderate, maybe 5%. I think you need to be using the derivative overlay to enhance portfolio returns at the moment. From an index perspective, we see the US market just breaking out above the resistance. The unknown is, do bond yields continue to move higher, or has the adjustment sort of completed itself? Looking at screen here, this is an index of the top 50 stocks. We've got this higher high, higher low structure. If the market was to reverse back down and sort of take out this sort of 5,000 level, I think I'd start to become concerned, and we'd take a look at what we could do to protect or hedge portfolios. At the moment, I think sort of look to take advantage of some of these oversold defensive opportunities and run tight covered calls. Thank you for listening in, and if you'd like to know more about the Investor Signals service, I'd be very happy to have a chat with you about working in partnership with you to manage your portfolio. Please contact me using the details on screen.